After the significant rally in the S&P 500, we're now at 22 times forward earnings. How can we justify that?
Either the S&P 500 needs to grow earnings at something like a 15 to 20% clip over the next 3 years, or the Fed needs to cut the Fed funds rate by 2.5% to 3%. Both of those seem like a tall order.
U.S. stocks outperformed foreign stocks by nearly 400% cumulatively since the financial crisis. Until this year. What happens next?
While the outperformance of foreign stocks versus U.S. stocks this year has been historically significant, it was predicated on expectations of better relative economic and earnings growth outside of the U.S. In order for this to continue, we need to actually see foreign economies and foreign companies deliver on those expectations, which is a big ask.
Hello and welcome to the Outlook by STRAT. Mike, we're halfway through 2025 and it has been a pretty topsy-turvy ride. We saw the S&P 500 down over 18%, and then we saw a recovery on par with the fastest recovery we've ever seen from those levels. So let's talk a little bit about what was driving that type of market behavior, and more importantly for our viewers, let's cover our second half outlook for US stocks, foreign stocks, and fixed income. Starting on the US side, one of the biggest things that's driven that environment has been tariffs, right? You had the announcement of the tariffs and then some pullback of rhetoric, some trade deals. What's going on here?
Yeah, at one point post-Liberation Day, and as it started to escalate with China, the average effective tariff rate in the US was expected to be almost 30%, in the high 20 percentage point range, which if you trace this light blue line back to history would be like the highest since the 1900s. So that was a huge shock to markets. Yeah. And since then, there's been a tremendous amount of quote unquote progress, striking deals. That average effective tariff rate is expected to settle in at around the 13 percentage point area. So, pretty much half as much as it was at the worst of times. And the market got really excited about that. Yeah. What we need to think about now is, now that prices are much higher for the stock market, is the stock market thinking that 13 percentage point effective tariff rate is going to work its way down to zero? Because we don't think that. That's not our base case. We think Congress needs those tariffs in order to make the budgetary impacts of the big, beautiful bill work. So how else then would you rationalize this recovery that we've seen and the prices that we currently see is the question.
Yeah, exactly. Let's dive into how we could potentially justify U.S. stock valuations, because we are in this environment lately where the forward earnings yield on the S&P 500 is at or even below the level of the effective federal funds rate.
Yes, and this is something that generally shouldn't happen. You should expect a higher return on a basket of risky stocks than you would on a risk-free asset. But the market is efficient, so you have to somehow rationalize these valuations. They can't be that wrong, hopefully. So the first way to do it, when you talk about valuations of the S&P 500, you'll hear most commonly quoted a forward PE ratio. Yep. So the price versus the expectation for the next 12 months of earnings, that's somewhere around 22 times next year's earnings. How do you rationalize that? Because since 1990, in a typical bull market, the average forward PE ratio for the S&P is closer to 16 or 17 times. Yep. So how you would rationalize that from an earnings standpoint, you would say the price I'm paying today is appropriate if the S&P 500 over the next 3 to 5 years can generate something like 15 to 20% earnings growth per year. How reasonable is that assumption? Because that would be exceptional. That would be on par with some of the fastest earnings growth over that amount of time that we've ever seen. So one of two things has to happen here. Either the Magnificent Seven have to be as magnificent as they've ever been from an earnings growth standpoint, or the other 493 stocks really need to make up the slack. But either way, the earnings growth needed to rationalize this forward PE ratio, it's about twice as high as what analysts' consensus is. So we need to see some outperformance from earnings in order to justify a 22 times PE ratio.
Yep. Of course, the other way you could look at it is relative to fixed income, right? So the flip side of that is, well, if the Fed cuts the federal funds rate by 2.5%, 3% from here, then those S&P valuations start to look more reasonable.
Yeah.
So we start to think about how reasonable of an expectation is that. We think it's pretty aggressive, right? We think the Fed may be good for 1.5% worth of cuts. Not to mention how thin of a needle that is to thread, because if you're getting more cuts priced into the market, that usually means economic growth or projected economic growth is slowing, which of course US stocks wouldn't like.
Yeah, they wouldn't like it. It would be a lot harder to generate those earnings if we're in a recessionary type environment where the Fed has to cut rates to 2.5%.
Yeah.
So the picture we're painting here is the gains from the lows in April, in hindsight, I guess, were the easy money. From here, if you look at valuations, if you look at our investment framework, most large cap areas of the US stock market are at best fairly valued.
Yeah.
And so you're just going to need to see some earnings outperformance. It's more of a show me phase now.
Yeah.
Yeah.
Yeah, exactly. And even with these lofty expectations that are getting priced in the US stock market, foreign stocks have still outperformed significantly, looking at a broad basket of foreign stocks relative to the Russell 3000, outperforming by 15% here year to date. And that's pretty notable.
Yeah. Over a 6-month time period, foreign stocks outperforming the US by 15% is on par with the best 6-month outperformance for foreign stocks we've ever seen. Matched by 2008 was the last time it was anything near that. And it comes after this incredible run of US stocks outperforming the rest of the world. Since the global financial crisis, the US stocks have outperformed the rest of the world by a cumulative 397% before this year, right? Just an incredible run. And a lot of that, though, was justified. It was not all just exuberance. US companies out-earned the rest of the world by a huge magnitude, and the US economy outperformed the rest of the world by a significant magnitude. So coming into this year, everybody was on one side of the boat, historically underweight foreign stocks versus US stocks. The US dollar was very strong relative to foreign currencies, and that started to flip because of expectations that the policies enacted by the Trump administration, particularly tariffs, were going to mean worse things for the US economy and the earnings environment. And the reactions from foreign economies, mainly doing their own stimulus, taking control of their defense budgets, were going to be good for foreign economies and good for foreign earnings. So this adjustment we've had year to date, this repositioning, was based on expectations. But from here, once again, we're at the show me phase.
Exactly.
For this to continue, for foreign stocks to continue to outperform, you need to actually see stronger economic growth outside of the US and stronger earnings growth. And that is a much longer putt.
Yeah, yeah. And as you mentioned, one of the tailwinds for foreign stocks year to date has been foreign currencies getting stronger relative to the US dollar. So a question that could come up is, well, what if that just continues? Right. That could support foreign stocks from the perspective of a US investor. But as they tend to do, we believe that currencies have somewhat overreacted to this situation, right?
Right. We look at currency valuations relative to economic fundamentals. How do we get a gauge of economic fundamentals? If you look at the 2-year government bond yield in any economy, it contains an incredible amount of forward-looking information about expectations for economic growth, inflation, and monetary policy. And so you can look at the differentials in short-term government bond yields between the US and other economies and say, well, how exceptional is the US economy expected to be over the next 2 years? Mm-hmm. And so that's the blue line. Right now, US 2-year Treasury yields are about 1.9% above the average of other major developed markets. So the US is still expected to be exceptional. That's what the bond market is thinking. And currencies generally follow that. This green line here is the US dollar index. You see it basically tracks those government bond yield differentials we saw. And now we've overcorrected to the downside. So in order for the dollar to continue to weaken, foreign currencies to continue to strengthen, you need the US economy to really be less exceptional and the Fed to cut rates far more than we're expecting. So it's just going to be more difficult from here for foreign currencies to continue to rally like they have. So it speaks to everything we said on the last slide. Yeah. It's just a harder putt from here for foreign equities to continue to outperform the US.
Yeah, absolutely. So let's transition from stocks to fixed income. We've made it this far into the video without even mentioning the big, beautiful bill. As we talked about in our last Outlook, that was going to be a driving force of our outlook for long-term fixed income in the second half of the year. Our thought process was, in conjunction with the big beautiful bill, the debt ceiling will be lifted, the TGA can regrow their account, and they will likely need to do that based on their prior description of their preferences by issuing long-term bonds. Mm-hmm. And our thought was that could put some upward pressure on long-term Treasury yields. But that seems to have changed the Treasury's thinking here recently.
Yeah, that outlook has gotten far less dire, far more benign, which is exciting. I mean, it's not only good for the bond market, it's also somewhat good for the equity market.
Sure.
Basically, the big beautiful bill is going to be passed before we thought, which means the debt ceiling is going to be lifted sooner than we expected, which means the Treasury doesn't have to continue to pay all the bills for the government out of their bank account at the Fed for as long as we thought.
Yep.
Which means their bank account is not going to get drawn down as much as we thought, which means they don't have to rebuild it as much, which is great. So the timing of the big beautiful bill being moved up, it does mean good things for the Treasury market. The Treasury doesn't have to rebuild their account as much. And then the other kicker here is Treasury Secretary Scott Bessent said recently this week that as we get past this debt ceiling and we get back towards rebuilding the Treasury general account, the Treasury is not going to increase the size of auctions for intermediate, longer-term Treasury bonds, 5s, 10s, 20-year, 30-year bonds. Not going to increase auction sizes. So they're going to issue bills. There is plenty of appetite for bills. How long can they do this? Well, they're going to try to do it. They're going to try to just issue bills and not issue longer-term debt until they get their guy leading the Fed, whoever that is. And it could be Scott Bessent, but that's the Trump administration and the Treasury's approach to this. We don't want to issue any longer-term debt as long as Jerome Powell is Fed chair, because he's keeping rates too high. And if we have to issue longer-term debt when rates are this high, it means bad things down the road, too much interest expense. So we're just going to wait them out.
Yep.
And
most of our bills will mature by the time we have our new Fed chair in place.
Exactly. So a little better outlook for fixed income than what we articulated in our prior outlook video because of all these factors.
Yeah. So we've got some lofty expectations that the global stock market is looking for, but maybe a more benign, maybe even exciting environment for fixed income here potentially.
Yep.
And that will do it for this edition of the Outlook by STRAT. If you have any questions or comments, please feel free to reach out.